How did you build something for so long and stay so successful?
I actually lost everything in the great financial crisis and lost everything before that in the dot-com crash, and both were driven by the public market crash. I was really looking for something, and I was looking for something with more predictability versus the public markets, which just are pretty random, and started Aspen Funds. In the aftermath of the great financial crisis, we discovered distressed debt. So we bought debt for pennies on the dollar. We started distressed debt funds and made a lot of money.
Everybody, welcome to season 2 of Wealth Unfiltered. I'm Samantha Parinello, your host, and I have a wonderful guest for you all. I have the pleasure of introducing you to Bob Fraser. He is the co-founder and CFO of Aspen Funds. Welcome to the show.
Yeah, great to be here with you, Samantha.
We are very excited. Our listeners, obviously it's Wealth Unfiltered, right? So we talk about what's going on in the economy. We talk about multifamily with Viking Capital, but we really want to explore, other groups and give our listeners exposure to people and to investments and honestly insights to help them through their investment process. So I think it's really, really wonderful to have you on here. I know that Aspen Funds was started back in 2012. And you're being one of the co-founder for this company. I have to ask you, that was a tumultuous time, a recovery period for our economy, for the financial world. So what inspired you guys to start the company? And really, how did you build something for so long and stay so successful?
Yeah, great question. And I actually lost everything in the great financial crisis and lost everything before that in the dot-com crash. And both were driven by the public market crash and of crashes. And so I was really looking for something. I really love investing. I'm a kind of a quant analyst kind of person. And I was looking for something with more predictability and, more control, right? Versus the public markets, which just are pretty random. And you never know what's going to happen. And started Aspen Funds, in the aftermath of the great financial crisis. And there's always opportunities, right? And, everybody's concerned about, the banquet table that's empty in front of them, but there's always 10 banqueting tables behind you that are full. And that's what people aren't paying attention to. So in the aftermath of the great financial crisis, we discovered distressed debt. There was a lot of, you could buy debt for pennies on the dollar. And that's what we did. So we bought debt for pennies on the dollar. We started distressed debt funds and made a lot of money.
Okay. So how did that evolve into what you're doing today?
Well, we love distressed debt and we love debt anyhow, but there's always bigger and better opportunities everywhere. Our mission was always to find things that were kind of off the beaten path, so to speak, and things that had a lot of kind of why behind them, a lot of reason behind them, a lot of, kind of economic tailwinds and timing, et cetera, like distressed debt at that time, right? And so it was natural for us to just branch out. And if you look at our team, I'm one of 4 partners. I mean, we've got venture capital experts, we've got oil and gas experts, we've got real estate experts, development, credit experts. We're really very, very broad. We're not just, multifamily or like a lot of guys out there very focused. And that's fine if people want to focus, but we're much more just looking for the opportunities.
Sometimes when people dabble in too much, they get overwhelmed or they don't find success because maybe they don't understand it. And you're talking about the experts that you have, but how did you create a team of people who you really do trust, but also that have created such success being so broad?
There's 2 classes of thinking on this, right? Some people say, oh, only invest in what you know. But that's BS, because we don't start knowing anything about anything. I was born a child, I knew nothing, and I've educated myself in dozens and dozens of things. So the truth is you can learn anything you want to learn. And so what we find, if we find a compelling opportunity that we don't know enough about, we will basically start learning. We start finding partners, we start learning that space, we educate ourselves, and we find experts that we can partner with. So it's the same thing family offices do, right? As a family office, do you have to be an expert in absolutely everything? No. You hire experts, you find experts, and you deploy experts, right?
Absolutely. So how do you all, mitigate the risk and perform due diligence on so many different assets?
Yeah, well, it depends on the assets. I mean, so we're very, very good. We have deep personal experience in credit. So, One of our partners is a banker, and we've been doing credit for 15 years, so we have deep experience there. So we do a lot of due diligence, including market. We do background checks of from sponsors. We look at their track record, and of course do deep dives on the projects in things we're not experts, like in oil and gas. We're partnered with an oil and gas engineering and geology firm that has a 40-year track record of doing that. So they're incredibly good at what they do. And, and the market proves it. I mean, you can see the proof in the pudding because it's working.
So you guys at Aspen's Fund, you basically mirror the way that family offices invest and give that, ability to retail investors.
Yeah, absolutely. Yeah, family offices do things a lot different than the normal retail investor, even the wealthy individual retail investor. And we want to bring those kind of disciplines and that way of thinking to the normal retail investor.
What type of strategies help you do that and that really vary from the traditional, retail investor mindset?
It's looking for, I mean, a few things, but let's say looking for institutional grade investments. So we're very much looking for things that a billionaire would invest in versus kind of the little niche opportunities run by, small operators. We're looking for more institutional grade investments. We have a very disciplined approach. I think, retail investors are not very disciplined in their approach, and that includes the way they allocate. I mean, I could ask you, what is your allocation? And, most people don't even know what their allocation is. And certainly it's not something that is mathematically thought out. The family office investors for sure are doing that. They're also much more risk averse.
Right.
Retail investors are much more focusing on the upside, right? Versus the downside. And the truth is, it makes a lot more impact. Losses are far more impactful than gains. And so minimizing losses is far more important than maximizing your gains. And so institutional investors are just very, very different focused on that. So those are the kind of things we're looking at. We really try to be very risk averse. We look a lot at the downside more than just the upside, and look for institutional great investments. We're very disciplined, and we're encouraging people. I have a new book coming out and encouraging people to really be disciplined in their approach of allocation, of selection of sponsors, et cetera, like the family offices are.
So when you talk about that, like the selection of a sponsor, or you talk about a selection of a specific deal that an investor might get involved with, what are some of the parameters that you guys have hard stops on that you're like, I have to have this in order for us to even consider this sponsor?
Yeah, I mean, we actually do background checks. We make sure there's nothing shady. We look at other deals they've done. We make sure their track record is in fact what they're doing. Probably the number one thing we look at is co-investment, because so a sponsor always has the upside, right? They have the carry or the promote, whatever. So sponsors always share in the upside of a deal. And in that way, our interests are aligned. But what they a lot of times do not share is the downside of a project. And as you know, right, in our market, there's plenty of downside out there. And so what's going to keep the sponsor from walking away when things get tough? And I have that experience. I have literally had one of my personal investments. The sponsors just walked away from the deal.
Right.
And, after raising, I don't know, $80 million, walked away from the deal and left investors hanging. It's like, okay, well, he had nothing to lose. He had 50% fees on the upside and no co-invest. So it costs him nothing to walk away. So co-invest, make sure you're aligned on the downside. And as I've just said, the downside is more important than the upside. So co-invest, you want to look at, I mean, if there's one thing you look at, that's what you look at. The other thing you really want to pay attention to is the track record. That's the second thing you should look at. And the third thing is, especially for real estate, you want to really understand the cap table, because the cap table is the thing that determines your risk. After just operator character and skill, the cap table is where your risk lies, right? And understanding how much debt is in front of you and what are the terms of that debt. And that's what we saw explode in the multifamily crisis was, the debt terms changed, too many people too leveraged and with floating rate debts, and boom, it's a bug looking for a windshield. So, The cap table really determines a lot of risk.
You talk about how you guys have, obviously you're involved in many sectors. So when you look at your portfolio that you guys currently have at Aspen Funds, how much does the upside vary between asset classes and also the downside? Or you have to stay in one specific buy box mostly, or is there a pretty varying like rate, especially with risk involved?
Yeah, it's very different, right? Every asset class is different. We have, I think, 27 different syndications and funds we've done that are currently active right now. Some are open, some are to new investments, some are just we're in the middle of executing, but they're very different, right? Different risk profiles, different income profiles, et cetera. We have two fairly large private credit funds that are very, very safe. I mean, we're focusing on debt, so we're not the equity piece, right? So we're down the capital stack and focused on that. So those are very different and focused on income producing versus then we have other growth funds. We have oil funds, energy funds that are, have a ton of potential upside and incredible amounts of cash flow right now. Not everybody wants to, take the risk of commodity pricing. It's really kind of all over the map. And that's one of the keys family offices do is they make sure that they're diversified in their assets deployments, right, and their allocations, so that when something zigs, something else zags, right? And that's super important, again, mathematically.
I know that you said that Aspen Funds is available to retail investors. So how, like my husband, he's the VP of investor relations. So that it makes me think about, how much time is truly spent educating retail investors on one project at a time. But for you guys, you have such a wide variety. Do you have a team that's really, designated and delegated to working with investors' education?
Yeah, of course. Yeah, we have a very good IR team, and we're typically doing about 2 to 4 new funds per year. And yeah, we have a staff that is, we want to respond within hours and really a white glove treatment. We definitely treat our investors as the gold that they are and do everything we can to try and play our cards face up. We're very communicative. We're Midwest. I mean, we're very just, we are what we are, and we're not going to present something that isn't, or dress up a pig. If something's not going well, we're going to be telling you what we're doing and those kind of things, and definitely want to take care of our investors and be very responsive. And we're known for that, actually.
We talked about the financial crisis and then you getting started, but the last 4 or 5 years, basically since COVID, there has been a lot of ups and downs, and you're talking about across all sectors. You've seen, a lot of, adversity. You've seen a lot of ups. You've seen, basically all of it. How has your fund performed, or how have you guys had to pivot in these times?
We've been very lucky. And, of all of our different funds and syndications, we've got, I think, 2 that are under pro forma is all, and we're doing super well. We're very aggressive in the multifamily space during the big run up that a lot of people got in trouble. We never use bridge debt. We use bank credit, and we're never aggressive with the capital stack like a lot of people were. So we did super well. And now it's time to buy. We're looking at other multifamily projects, and it's time to buy. You can buy stuff really at a discount right now. Our credit funds just soared through COVID. Debt is just a lot more resilient. It does super well. And energy, oil is been our best performing funds so far. Meanwhile, we also have a huge industrial pipeline. So of industrial development, like big box industrial, like stuff Amazon would buy, right, or rent. That stuff hasn't had a hiccup. We pick our asset classes based on big macroeconomic trends that were unfazed by a COVID wave, right? You got these giant trends of reshoring, nearshoring that's driving industrial boom. You've got these giant trends of energy. So those things were unchanged. So because we weren't just following the consensus, but we're looking around a little bit, we've done very well.
So when you talk about the industrial piece, because, multifamily, the development has really slowed, obviously, with all things going on, but industrial has tended to be a lot more aggressive, I think, right now, especially with like the policy changes happening. So are you guys actually seeing an upswing in development?
Oh yeah. Oh yeah. Well, so what happened is during COVID, I mean, there's been a lot of industrial development for, let's say, the last 10, 15 years, and it's mostly due to e-commerce, right? The growth of e-commerce, think of Amazon, right? But what's happening now is COVID exposed the need to reshore and nearshore, which was already happening. Bringing manufacturing closer to America was already happening. COVID exposed it pretty big, the risks of supply chain risks and the mispricing of supply chain risk, which is now being fully repriced. Okay. And it's bringing nearshoring back. So we've got another 10 to 20-year run in industrial. But what happened is during COVID, the big developers put their pencils down and stopped building. Even though demand was still there, they just stopped. They paused. We didn't. We kept building because again we're looking at the math and we're looking at the big trends and we're saying this is not and so what's happening now is we have projects that are going to be being delivered here at the time when there's a huge shortage in the market. So we're actually way ahead of the game, and what seemed like maybe a risky call compared to others. For us, it wasn't risky. We're looking at the demand. We're saying, sorry, demand is going to be there. And it is. And so now we're seeing huge uptick in interest. The big, beautiful bill, if you break ground, a manufacturer buys one of our buildings, they can literally get a tax deduction for the entire price of the building, as long as you broke ground after his inauguration day. What an ego. But it is what it is. I mean, so it's just incredible for industrial right now.
Was it difficult for you to find a developing partner who was on the same mindset and trajectory as you?
No, see, we actually have deep development experience. So one of our partners has been in industrial development for decades, and so we just lit the fuse for that guy, and he's cranking. So he's just absolutely cranking. We have to raise capital through investors, so it's part of it. We want to educate our investors, and they went along with us. They said, okay, we'll go with you, even though a lot of them were not sure, but we do our best to really explain the why and why this is a compelling opportunity, and we were successful in doing that.
Are you looking to build sustainable wealth and achieve financial freedom? Viking Capital can help you do just that through multifamily investing. With a team of seasoned real estate experts, Viking Capital conducts deep financial analysis and data-driven asset management to deliver outstanding returns. Their strategy focuses on low-risk opportunities with significant value-add potential, preserving your capital while maximizing long-term growth. Join them and be part of a success story. Viking Capital has acquired 30 properties and manages over 6,000 units, all thanks to their dedicated team and valued investors. Discover their current deal offerings at vikingmultifamily.com and start your journey to financial freedom today.
Over the last, 4 or 5 years since there has been that, people obviously don't just invest in with one group or with one sponsor. And I'm sure a lot of your investors have other people who they've worked with who've faced adversity and maybe lost their money, like how you were talking about with one person who walked away from you. How engaged have your investors been still through that adversity that they're seeing with other people?
It's unfortunate to see, so many people losing money, but it's helped us because we've actually are pretty unscathed. I think we've got one project that's really troubled and the rest are doing fine. And we're going to make a lot of money on all of our projects. So it's pretty good. I think it's differentiated us a little bit. And, we want to be a little smarter than the average bear, but, some of it's luck too. And so I don't want to just say we're better than everybody else out there, but we definitely do our part to minimize risk and to try and be a little smarter than the next guy.
And for when you talk about, all these different sectors, does that mean also that you guys are basically national, or do you have like one part of like a region that you focus on for most of your investments?
No, we're definitely national. We do we are Midwest based and we love the Midwest. The Midwest is a great place for industrial development. It's a great place for multifamily. You're familiar with the multifamily crisis that's happening, and the Sun Belt states have been very overbuilt and way too many deliveries, and everybody was focusing on there, and now you're seeing negative rent growth. Midwest and Rust Belt, we've seen 6% positive rent growth. And these markets never had the boom, right, that the other markets had. They never had the building boom. But we have a really strong economy. So we do love the Midwest as just, for a few things like industrial and like multifamily. It's just a really good place. And oil, we're going where the oil is. We've invested a lot in Oklahoma. And now we're investing quite a bit in the Powder River Basin in Wyoming. You go where the oil is there.
I love that. I would say that's probably one of asset classes you probably have to do the most educating, right? Because I think
Oh, yeah.
most people understand industrial, they understand multifamily, they understand that to an extent. But I mean, gas and oil are very, I think, nuanced
Very different.
in your investment.
And it seems like everybody who's tried it has lost money, right? It's everybody's got a story. Like one of my partners said, here's the definition of an oil well. An oil well is a hole in the ground with a liar on top. And and I thought, well, and he's not wrong. But on the other hand, so you as an investor, does that mean you should stay away? Well, if you look at how many millionaires have been created, millionaires and billionaires in the oil patch, clearly there's money to be made, right?
Right.
So just be that guy instead of the other guy. And it's a matter of finding the right partners and the right strategies. And it's there. And even if you make a mistake, just don't keep making mistakes. Just don't make the same mistake over, and pretty soon you're going to hit it. But yeah, a lot of people are focused on drilling opportunities. I've gone to conferences, and it's just so disappointing to see oil companies there, these really small fly-by-night oil companies. One guy was selling a divided interest into single drill hole. You talk about freaking risk, and it was marked up like 10x from their cost. I mean, the risk is insane, and we're not doing that. We're not doing it. We're buying producing oil fields. Literally, it's been drilled. They're being produced, and it's being produced by public majors, Marathon, Devon, Continental, right? And we have these cash flows. I mean, literally, our last Fund 7, we closed February of last year. In March, it started dividending at an 18% rate.
Wow.
Yeah. I mean, there's the risk you're taking is not engineering risk. It's not geology risk. It's commodity price risk.
Right. Absolutely. Yeah, I started dabbling into gas this year, gas and oil, and I haven't even invested in it, but I started learning. For me,
Good.
It's a very slow trajectory to really educate myself on something before I'm willing to put money in, and that's one of the few things that I've
Perfect approach.
Crazy about.
Yeah, and you may not get it right at the beginning, but just put your capital to work in small ways while you learn the ins and outs and educate yourself, so definitely the way to go.
So how are you guys able to do the same thing for retail investors?
Well, they do have access to better deals when you write bigger checks. Well, but we are the bigger check writer. We find those better deals. I mean, in our credit funds, I think we reviewed 70 deals last quarter, that we looked at, and these are sponsors coming to us, and I think we funded 2 of them, and we're dictating terms. So we're telling people, if we like a deal, but we don't like the structure, we're telling them to change the structure to reduce the risk, et cetera. I think that's one of the things you can do we love retail investors. I mean, we have about 1,000 accredited investors. We don't take institutional money. Part of our mission, I love to do is to help retail investors. So we're never going to go away from retail. We're never going to start taking pension fund money and all this other money. We really want to help retail investors get institutional grade investments. So yeah, pooling your money as a retail investor into sponsors like Aspen, you can get better deals.
Do you guys use like any fund to fund managers who also kind of want to get involved and they kind of bring bigger checks, but still retail investors to your group, or are you the only one?
Yeah, absolutely. Yeah, we have a very robust fund of funds program. I think we've got about 30 fund of funds that allows capital raisers to go raise capital and bring to their retail audiences, again, institutional grade investments with somebody with great track record that can offer really, really good investments and to their audience. And we love it. We love working with people like that.
What do you feel like is the most common mistake that you've noticed with whether it's your retail investors or retail investors that you've seen across, other investments, like most common mistakes, but also like maybe do you have advice for those people on how to kind of fix that?
Yeah. Most common mistakes, I think, focusing on the upside, right? Looking at the headline IRR number, return number, which is nothing more than a promise, right? Versus really, really measuring risk. I think not really treating your investments like a business. This is where family offices, they treat their investments like a business, right? I am in the investment business. And every one of your listeners should treat their investments like an investment business. They are in the investment business. And that means you hire experts, you do your due diligence, you take the time to educate yourself with the books and podcasts and conferences, et cetera. Yeah, so those are definitely some of the main things should be different. And really being a smart allocator, right? Looking at not just, throwing money at whatever deal crosses your desk, but being proactive and intentional about where you want to put your money to allocate it in a way that's mathematically intelligent.
When you started, when you were thinking about your, not even the Aspen funds, but when you were starting your investment journey, what classes did you dabble in first and where did you find the most success initially?
My journey is highly integrated with Aspen, my firm. So my first investments are in distressed debt, and we did super well in that. My personal capital outgrew my firm's ability to invest. So I started investing in outside LPs. I made every mistake you can possibly make. But fortunately, hopefully, people can learn from my mistakes, and I put them all in the book. Here's the things that common mistakes that I made all of them. And
so you mentioned your book, but you also have a podcast. So let's talk about your podcast where people can listen to you and get more advice. And then let's talk about your book.
Yeah, Invest Like a Billionaire is the name of the podcast and the name of the book. So, and yeah, we just did a series on some of the worst mistakes we've made in investing, right? And I go through some of my mistakes. We go through, we're going through the book and going through kind of some of the main principles. Here's the book. It's just coming out now, and super, super proud of it. Worked very, very hard doing the research for all the book. And
is it available or is it come out next month?
It's coming out next month. It's coming out September 9th. So it'll be out September 9th. It is available now on pre-order on Amazon.
I'm pretty sure that's like when this episode airs. So babe,
come on, go
today. Yeah. It's like for you people listening.
And it's got an audiobook available as well. So
oh, that's amazing. How exciting. So is this your first book?
This is my first secular book. Yeah, I've wrote some other faith-based books.
Okay, amazing. Congratulations. That's wonderful. So for you, I saw, is this book you co-author with your son, or is he on the podcast, or both?
Both. So he co-authored, he's a banker and a real estate expert. So he co-authored those chapters and due diligence. And so it was kind of a joint effort. And then, yeah, he's really the lead of the podcast. And I jump in on the podcast to do a lot of economic research. I'm kind of the macro strategist. So background in, economics and mathematics. So I look at all the big trends. And so I'll do, once a quarter or a couple times you do a big economic forecast. And it's really our playbook. It's Aspen's playbook of where we are placing our capital and where we're looking for opportunities.
Well, I love that because that actually is a perfect segue to my next question for you. So based on what you're seeing in the current market, what you and Aspen have been, basically focusing on now, where do you see the next quarter going for Aspen Group or funds?
Yeah, well, we're going to continue to play the private credit markets. So private credit is booming right now, and you're seeing, banks have really shut off the spigots, and there's a lot of great opportunities. And private credit, you're much safer. You're going down the capital stack, and we're able to earn equity-like returns with debt-like risk. And so we're going to definitely be focusing on private credit. It's a real growth area for us. We're focusing a lot on oil and gas. Again, I've said in the past, oil and gas right now is a generational buying opportunity, once in a generation. We've seen prices for producing oil and gas assets are down about 75% from where they were prior to the great financial crisis. So we're just backing up the truck and buying everything we can in oil and gas right now. Great assets. Industrial playbook is, the big beautiful bill and Trump. It's only accelerating what's already been a giant tidal wave of demand. And then multifamily, we think it's time to be getting into multifamily. It's funny, I still see a lot of multifamily being done wrong and people that are overpaying for assets. But it's the right time to be buying assets on the cheap. And you can buy really good assets, especially B's and C's, B and C class, for, the price of the debt. So you're getting a 25%, 30% discount from where things were priced before, and in really good assets and really good locations. So we're going to be kind of upping our game there and probably starting a new evergreen fund this year in multifamily.
So when you guys put a fund together, how many assets do you typically acquire for the fund?
Well, it depends. So when we do an industrial build, it's a single asset.
Okay.
Single will be maybe like 5 buildings, 1 million square feet, but we'll build one building at a time. But it'd be, so I don't know, is that one asset or find assets. The oil funds will deploy until we've purchased 70 million. So it'll be as many as it takes. For multifamily, we're gonna do a combined fund, an evergreen fund that'll purchase many multifamily properties. So it's very different. In the credit funds, I mean, one of our funds, we have 800 mortgages right now in the fund.
Wow.
So it's huge. Another one, I think we've got much larger opportunities and about 15 deployments. This is in multifamily credit. So yeah, all over the map.
So I have a question, and it's kind of looking at this as the person who's sitting in the opposite seat from you. So if I were an investor and somebody was coming in and telling me, I was looking at a deal, whether it was, industrial or if it was multifamily or whatever it was, and I was told that your company was going to come in and sit as the debt in lieu of like a major, you know, person, whether it was Fannie Mae or Freddie Mac, or if it was, even just like a loan that was more from like a bank versus private. So if I saw you guys coming in as an investor for that deal, did that scare me more? Is that more risky for somebody? Like, what does that look like from that standpoint?
Yeah, two things. It should give you confidence and scare you. So yeah, because one, if we're doing a deal, the deal is really good. Okay. Means the operators are good, the market is good. It means it's going to be a really good deal. But we are stepping in front. So we're doing mezz pref equity, right? So we're stepping in front of the common equity. So we're not taking near the risk the common equity is doing, and it increases the risk of the common equity. So you want to pay attention to that and make sure that you really believe in the deal, but we say we believe in the deal, but we believe in it from much less risky standpoint though. So yeah.
How many do you think at this point, do you guys have of new investors who are joining your funds? Maybe annually?
Oh, probably 200 or 300.
Wow. Okay. So do you expect that that's going to continue to be the progression over?
Yeah, definitely. We're on a kind of an exponential growth path right now. We 10x'd in the first 5 years, we 10x'd in the second 5 years, and we'll 10x in the third 5. So doing it smart, and there's no shortage of investors that like our playbook. They want to place capital with us. They trust us. And doesn't mean we're going to be perfect, but we don't have the perfect crystal ball, but we work really hard and we're very honest. And, that's really what you want. It's just, are people going to, if something's not going well, are they going to be on it? And are they going to be, not take the risk to try and do smarter deals? So people definitely love that. And they like our, with the multifamily debacle and the office debacle, a lot of investors are really looking for, wait, what else is out there? And we have an answer for you, right? That there's a lot of other things. So I think investors love it, and they love the podcast. It's an award-winning podcast, and I'm hoping the book does really well. And I think we're going to hit the bestseller list. And really, my hope is it'll really educate a lot of investors and show them really how to earn higher returns and take less risk, like the ultra wealthy do.
Yeah, absolutely. What do you think, or maybe you guys have like a true number for this, but what do you think is the runway for somebody who's brand new? They've not really heard a lot about you guys, and they're trying to get their feet wet. How long do you think it usually takes you to get them over the hump for the first investment?
Yeah, it's funny. A lot of times they'll write one check into our lowest minimum fund, or something like a $50,000 check, and that's fine, great. But I tell you, within 5 years, they love us and are typically writing most of their capital with us. A lot of guys have the stories of, a lot of other sponsors I haven't done well with. And Aspen I've done really well in all my Aspen investments. And I mean, hey, there's some luck in there too, but we do have a really good playbook. And I think it takes a few years where people, they dabble, they dip their toe in. And honestly, that's fine. Dip your toe in, right? Get to know a person, I mean, you said you're investing in gas and by just doing a lot of research, but you haven't invested yet. And that's great. But a lot of times what I find is that I want to write a little check first. And as soon as I write a little check, well, now I'm going to start paying a lot more attention. All of a sudden, when I write a check, well, now I'm noticing the articles that are coming across my desk. I order books and I read that. I listen to different podcast episodes. So it's a way to motivate myself to get educated, So I like places like Capital work. And it's great, get to know a sponsor by dipping your toe in and say, are they honest? Are they good communicators? Do they do what they're saying? Are they successful? And it's nothing wrong with that.
I have two more questions for you, and I really appreciate your time. So you spoke about how you do, macro strategy for all of Aspen funds, and you really look at the economy. So what I wanted to know from you is if there were two or three macro trends that you were looking at right now in the economy, what would it be that investors should keep an eye out on?
Yes, great question. And I would definitely say sign up for a podcast and get the current data. But as I speak here, because we're always updating our thoughts. I mean, I called higher interest rates. I called higher inflation. Those are the things that are at work in the last few years. Those things are still going to be in play. We have inflation is a structural problem right now. It's not cyclical, and we're going to see inflation continue to be sticky and difficult. And right now it's driven by the labor market. It's going to continue to be driven by the labor shortage. And it's only made worse by the immigration policies that are being adopted by the current administration. That's a biggie. Interest rates, unfortunately, as a real estate guy, I wish they would come down, but I think they're going to be stickier, higher. And there's reasons for that. You're seeing, again, it's structural. If you look at the total amount of the Fed determines short rates, but long rates are determined at auction with supply and demand. Well, who's the supply? It's U.S. Treasury. Well, the amount of treasuries outstanding is six-fold higher than it was prior to the great financial crisis, 6 times as much debt. Yeah. Well, so that's the supply. So imagine if you had 6 times the multifamily supply, right, in the market. And so interest rates are going to be higher because of that. Add to the risk factors, the latest news, Trump is trying to take over the Fed. It just increases risk and volatility. And it's going to raise interest rates, unfortunately. He thinks he's going to lower rates, and it's actually might do just the exact opposite because it's an auction. So those are some of the things that I think are at play. I also think energy is, we've seen investment pullback from oil and gas exploration development. About half as much investment is going into oil and gas development was going in 7 years ago. There's going to be an energy crisis at some point. Those are some of the trends I look at. Demographic trends you're seeing. It was Wall Street Journal just today was talking about the big demographic problems, and we see worldwide the birth ratio is below break even. So we're seeing declining populations, and it's way worse other nations. That is the most important economic trend in the world. But it's like a glacier. It doesn't change much, but it shapes the entire landscape. But from day to day, it doesn't look much different. So those are some things I'm looking at and think a lot about.
I love that. Thank you so much. I feel like that was hopefully like eye-opening for a lot of people, because I think that some of what's going on politically, also what you're seeing with interest rates and with Powell's recent statement, I think it's a little confusing for people. So I think it's nice to have someone like you who comes on and like kind of breaks things down in a way where we can all really understand it. So thank you for that.
Yeah.
My last question for you is we're in a time of AI and a lot of disruption happening, and you guys haven't touched on anything AI-esque, that you've like talked about for funds. Do you guys have any intention of getting, I don't know, involved in anything like that? Or do you foresee anything changing due to AI from what you guys are doing?
Yeah, Aspen has not done any private equity yet. I think it's on our radar, but it's a big leap, and we're not there yet. We've looked at, data center real estate. It's a super frothy market. It's a very difficult market, and also, I mean, so you had the internet boom. Do you remember who the biggest internet players were in the internet boom? AOL.
AOL, yeah.
Yeah, Netcom. They were the biggest, and they're and the end of the social media boom. You remember MySpace?
Yeah.
So these are cautionary tales. A lot of times, the very first guys in the market are not the guys that are going to win. And they're, just because you spend a lot of money and you have a lot of profile doesn't mean you win. So I'm very cautious. I'm like, I'm happy to let things settle out. We're seeing huge amount of disruption, but the opportunities are not yet clear of where the investment opportunities are, right? And there can be great technologies. That doesn't mean they're great investments, right? I mean, aircraft have been a great technology for 100 years, but it's never been a great investment.
Yeah.
So I, as an investor, I want to be disciplined, and I'm looking for where are the great investments. And right now it's so frothy, it's like trying to invest in, blockchain or Internet of Things or, whatever the last trends were. These trends all just create a lot of energy, but they end up not making a lot of money. And I want to make money.
Right. I think all investors do.
Yeah.
Awesome. Well, I want to say thank you so much for your time. I hope our listeners really enjoyed it. And if you just want to tell them one more time where they can find your book, because comes out, today when they hear it.
Yeah. Well, it's super great to be here with you, and I hope your listeners are learn something. But fantastic questions, Samantha. Really insightful questions, and a great show here. The book is called Invest Like a Billionaire, and it's available on Amazon. We also have some free bonuses if you want to go to thebillionairebook.org. A lot of free bonuses that you can get as well.
Awesome. Well, I'm excited to check it out. I love learning. I love books. So grateful to you and your son for taking the time to create that for everybody. And thank you very much.
My pleasure. Great to be here with you. And hope all your listeners have a fantastic investing year.
Amazing. Thank you. Thank you for tuning into this episode. We truly appreciate your support. Don't forget to subscribe, leave us a review, and share the podcast with your friends. Until next time.